Let's talk about a risk-on trade that's betting on a Fed pause. We're tracking investors plowing into names like McDonald's, Oracle, Lerner, as exuberance around cyclical stocks continues to take hold. But what's driving the investor moves into these economically sensitive household name stocks? Keith Lerner, Truist Co-Chief Investment Officer, is here with us. Keith, thank you for coordinating with me today with the jacket and dress. So you talked in your latest notes about the resilience that we seem to be seeing in stocks here. Our editor, Brian Sozzi, wrote about economically cyclical stocks in particular that are seeing resilience. What's driving all of this?
I actually think it's actually somewhat mixed. There's resiliency at the headline number. The popular averages are doing well. Markets up 8% this year. But I actually would say there are some pockets, like the home builders are doing fantastic, better than most people would expect at this part of the cycle. But when you actually peel the onion back a little bit, you're actually seeing some weakness. The average stock this year is only up about 2 or 3%. Small caps are closer to the lows and the highs for the year as well. And then financials are also obviously struggling as well. So I think it's actually a much more mixed picture. And when we look back at historically at new bull markets, some people are calling this a new bull market. We're skeptical still. Even with this S&P up about 15% since the October lows, normally at this time of the market cycle, you're up double that, and you're being led by those areas like small caps and financials, and we're not seeing that. And our point at this part right now is that the market is pricing in a lot of good news and not leaving a lot of room for error. Though I will say positioning is somewhat light, and that's given a buffer for this market right now.
Where's that good news anticipated to come from?
I think right now, if you think about the whole debate that we're having from day to day, hard landing, soft landing, sure, inflation easing or not easing, and I think right now the earning estimates they were cut now they've kind of flatlined, and I think there's some optimism that those earnings could come through. We're skeptical, and the reason why we see a disconnect in what we're seeing from the industry analysts, which you all talk a lot about, which are expecting earnings for the S&P to hit a new high in the second half, versus the economic estimates, which are showing a pretty significant slowdown, which we agree with in the back half. And then you look at the overall S&P as a whole right now, we're trading at a pretty lofty valuation. We're around 18.2 on a forward basis. That's the high end of the range outside the pandemic. So in order for you to think there's a lot of market upside at this point, you have to believe one or two things. One, you're going to trade at a really high premium valuation relative to the last 30 years that you've only seen really during the pandemic or during the technology overshoot back in 2000, or that earnings are going to be stronger than expected. And I think it's possible. I just don't think it's likely.
I'm sort of going to ask the flip side of that then. What could go wrong? I mean, you talked about that maybe we won't meet those various expectations, but are there specific negative events that you are watching for?
Well, I think when you're trading with a lot of good news, and in our view, you're trading for a soft landing. That's what's embedded. So if you have something where the economy actually deteriorates somewhat in the second half, I think that by itself could bring down earnings. And then we also have obviously the debt ceiling that's coming up over the next few weeks. And there's always something that we don't know about that could come later on. So I just think that the market it's one thing if the market was baking a lot of bad news already and it's trading at a 14 or 15 multiple, you get bad news, it can absorb that. If you get something from left field that we're not expecting, I just don't think there's much of a buffer. Again, the main thing I think why this market's been creeping up, though, is there's big cap growth stocks, which you talked about, but they're also now trading at the highest valuation in about 20 years relative to the market. So the question at this point is, tech is still leadership, but what else is there out there to bring this market up with technology doing so much heavy lifting already?
With what we've seen within the banking crisis itself and what took place with regard to a run on deposits specifically, is there anything that is kind of a common denominator in the equity market way of thinking as well, to say if we did see one of those unforeseen events, that we would see a similar kind of head for the exit type of event for investors?
I don't know that we're going to just see like a head for the exit tomorrow, because again, the one good news for the market is if you look at all the different surveys, positioning is still relatively light. But I just think it would be more of the realization that the economy is actually slowing down and moving to a point where people keep talking about a recession and it keeps getting pushed forward. They actually start seeing some weakness. And where you'd probably see that manifest itself initially is in the weekly jobless claims, which is now coming off the lows. But I think, again, it's people have moved to the growth stocks and they're kind of hiding out there. And, if you see some weakness there, I think that would cause some greater concern because it's such a big part of the overall market today.
Right. And to your point about the average stock only having risen a little bit, it's those tech stocks that have pulled everything else along. We mentioned in the beginning the economically cyclical stocks as well that are seeing some renewed attention. Is there also then vulnerable? I mean, it's right there in the name, economically cyclical, right? The idea would be that those would also be vulnerable in the second half if we see weakness.
Yeah, I think so. But again, I mean, I would say, I mean, look at the economically sensitive sectors. Like home builders doing great, semiconductors are economically sensitive have done great, and that's partly because I think the CHIPS Act, which is probably underreported somewhat. But if you look at economically sensitive materials, energy, they're really at best market neutrals at this point. They're not leadership in the market. So when you look at the year-to-date gains, it's tech, communication services, and discretionary. That's over 40% of the market. But besides that, it's really a mixed picture. And more recently, some of the defensive areas of the market are doing better as well. But these other areas just aren't that big enough to really drive the big gains for the market. So that's why we, in our view, we think the upside's somewhat capped. We're overweight fixed income and cash relative to equities. We still have equities. Time frames matter. It's hard from week to week, but we're looking in the next six to 18 months. At this point, we're still underweight equities.
All right, and that as we get the opening bell here this morning, good timing. Keith, it's great to see you in person.
Great to see you guys.
It's been a long time. Keith Lerner, Truist Co-Chief Investment Officer, thanks for coming to visit us in studio. Appreciate it.